So I'm neutral on those. I do eventually expect to see a curve steepening either because the front end's cut or because the long end rises a little bit or a mix of both. And so the overall risk reward of the long end is still not super attractive to me. To the extent that I like bonds, I either like T-bills or I like intermediate term tips. For example, I don't particularly like the long duration bonds, which is not to say that I don't think that they will, it's not that even if they squeak out gains for the year, for example, there are much better other assets that I'd prefer to own from a risk reward standpoint. I prefer to own things that I view as asymmetric, meaning that the downside is relatively contained, whereas the upside has a lot of room to go. And I don't view the bond market in that situation. I wouldn't be surprised if we see yields higher or lower by the end of this year, but it doesn't feel like it's weighted toward a kind of a strong long outcome. So it's just an area that I kind of put into the too hard pile and say that it's not a lot of opportunity for the amount of risk I take on.
In today's market analysis, Lyn Alden discusses the nuanced dynamics of bond yields and inflation expectations. With yields potentially staying higher and inflation stabilizing around 3% or higher, investors face uncertain prospects in crowded equity sectors. Alden emphasizes the importance of monitoring energy markets for signs of elevated inflation, suggesting potential challenges ahead for the economy.
Or it stays sideways while the Fed cuts the short end. There's a couple of different ways and magnitudes that could happen. And to the extent that long end yields stay higher than expected, that could put pressure on some of those highly valued equities that we just talked about, right? So I think the bond market's already a little worried about reaccelerating inflation, where we haven't really seen that in the large cap equities yet. I think that they've still discounted the possibility of reaccelerating inflation, and so some of that's potentially not priced in. And so those crowded areas might not, they might correct or at least stagnate for a period of time if they come to fully realize that the long end yields are maybe not going down as quickly as some investors expect. So I think we're seeing stabilization of inflation, and the step before reacceleration is stabilization. So if it's not going down, that's a sign of a potential bottom. Um, and one of my themes for a while is that this decade will be more inflationary than the past decade, but it won't be a straight line. It'll come in waves, as most inflationary decades do, and that those waves will generally be correlated with economic acceleration or deceleration, especially some of the more energy intensive areas. And so, for example, PMIs, like we just talked about, have been falling and for a while. They then have been stabilizing for a while, and they're actually showing earlier signs of recovery and reacceleration. And I think inflation could follow that with somewhat of a lag. I do think if we see a continued PMI upcycle, that could come with a little bit of inflation. So it's not like I'm forecasting inflation to quickly retest the highs we saw, a couple of years ago. But I do think that the Fed's it's going to be sticky. It's going to be basically inflation's not going to go down to the Fed's target as quickly as they'd want it to. And that inflation, I think, is going to hover 3% or higher, most likely. And I think the key thing to watch to see if it can go much higher than that is energy. I expect rent inflation to kind of stabilize, not really trend lower, but not necessarily explode higher either, because there's a lot of supply coming online. But it's really the energy markets that I think are worth watching to see if we end up having above, like inflation that's even above kind of current levels that are already elevated relative to targets.
Continuing the discussion, Lyn Alden highlights the challenge of addressing inflation in the current economic landscape. With fiscal deficits surpassing private sector credit creation, traditional monetary measures face limitations in curbing inflation. Alden suggests that the Federal Reserve may focus on managing expectations and maintaining relatively high interest rates, while fiscal policies play a more dominant role.
I think neutrally. I think that they already kind of realized that their tools are not necessarily well positioned to deal with this. So when I talk about fiscal dominance, what I refer to is when we look over let's call it, I did charts on this. Like, for example, the past 70 years, if you look at where most credit creation happens, right? Mostly it's in the private sector. So, for example, if you sum up net new bank loans and net new corporate bond issuance in a given year, that sum is usually bigger than annual fiscal deficits. So that's kind of private sector, Main Street, credit financing. Um, and for the most part, that's bigger than annual fiscal deficits. But one thing we've seen in recent years is that fiscal deficits are bigger than those combined, right? So there's more kind of nominal power coming from the public sector than the private sector. And that has a couple implications. Basically, the Fed's main tools are around modulating the speed of things like bank loans and credit issuance. If they want to try to slow down inflation, they try to raise rates or do quantitative tightening to try to slow down that private sector activity until they get, either a recession or a near recession. And the problem is that in the current era, because the deficits are mainly, it's mainly a fiscal driven large deficit phenomenon, that's where the inflation's coming from. There's only so much that they can slow down that private sector. And a problem is that, back in the 70s, for example, or the early 80s, when they wanted to try to control inflation, they had very low public debt. And so if they raised rates, they could slow down that private sector credit creation, and that would have a bigger negative impact than any sort of increased public interest expense they would have from those policies. But if you fast forward to the current time, instead of 30% debt to GDP, there's 120% debt to GDP. And so when they raise rates super high, it does slow down that private sector credit creation moderately, but then it completely blows out the public interest expense and overall fiscal deficits by an even larger number. And so they're not really able to slow it down to the extent that they would be able to if they were in a lower public debt environment and where most of this was coming from that private sector. So it's really about not having the right tools to address it directly. And I think that, they've been kind of been acknowledging that, even just not directly. So I think what you would generally see is they'd probably stick at relatively high interest rate levels. They probably would not aggressively raise them more. They might focus more on curve steepening because that's a way to, moderate costs for the government, while keeping higher interest rate pressures on the private sector, mortgage rates and corporate bond rates and things like that. So I do think that they might start targeting curve steepening. But I think it's mostly about just expectation management. I think they're going to be relatively neutral even if inflation reaccelerates. And I think it's going to be an ongoing kind of narrative issue for them. So it's possible. My base case is they would first focus on higher for longer rather than raising rates, because I actually think that the raising rates beyond a certain point can actually be stimulatory. That's the challenge you face in a fiscal dominant environment. So if most of the money creation was happening because of the private sector, then higher rates would generally be not stimulatory. The opposite, it would be depressionary. But because a lot of this is fiscal driven, and that's interest rate, it's not sensitive to interest rate. The spending, the taxation, it's largely not sensitive to interest rates. And so by raising rates, they actually just increase the deficit more. And that's where a lot of the stimulus is coming from. And so, they might turn to rising rates, but I think it would be ineffective if they did. Instead, they probably will just kind of keep it high, and we'll see if they try to rotate the yield curve to be steeper. That might be one of the more optimal approaches. But really, it's I'm less concerned with what the Fed's going to do because I don't think they're in the driver's seat. I think the fiscal side's more in the driver's seat, and I think that the Fed's going to kind of move around whatever the fiscal side's doing.
Thanks for tuning in to today's insightful analysis by Lyn Alden. To recap, Alden discusses the nuanced dynamics of bond yields, inflation expectations, and the interplay between fiscal and monetary policy. With inflation hovering around 3% or higher and fiscal deficits surpassing private sector credit creation, traditional monetary tools face limitations. Alden suggests that the Federal Reserve may focus on managing expectations and maintaining relatively high interest rates, while fiscal policies play a dominant role. Don't forget to subscribe to our channel for more in-depth market analysis, like this video if you found it helpful, and share your thoughts in the comments below.